Let's take the conversation forward with Deven Choksey as well. Deven, hi, let's just start with that. Which is the PSU that you're still comfortable buying at the current level?
Yeah, good morning, Anisha. Well, I think most of the companies have probably corrected on the valuations, or rather, I think re-rated themselves on the valuations. So, from a perspective of looking at something which is very undervalued, I think that situation is no more there. The likes of REC, the likes of PFC, I think, which have performed significantly in the last year, I think they basically re-rated themselves in a given situation when I think after the cleaning up of the balance sheet and after I think seeing the surge in the offtake in the loans, I think they were still languishing at around 1.5 price to book value. They got correct, they got re-rated, and they probably I think got I think the valuation which they deserve today. Similar situation is happening with most of the public sector companies. Great models, great businesses, but the valuations have already, I think, reached to a level at which one could possibly say that look, they are now fairly valued at this point of time. So immediately there is nothing comes in the mind where one could possibly, I think, ask for buying into the portfolio. Maybe one will have to wait for the corrections in the market to buy some of the PSU companies if at all one wants to buy. I still believe that the PSU companies are great business models, but I think sustainability of the growth will have to be experienced by the market going forward in coming year. And as they are, I think government is spending on infrastructure. Around 15 to 20% kind of a growth is a safe growth to assume. Beyond that, if the market has assumed higher growth and given higher valuation, I think some of these companies might end up giving a rude correction in time. So I think so one will have to be a little bit more careful about buying into euphoric condition into the PSUs.
What is looking euphoric in PSUs? Metals, power, railways, defense? Because PSU itself is like a big basket of variety of businesses they will buy.
It's true, Nikunjan. I think you touched upon metals. I believe that I think the metals could be one which could possibly be surprising the markets going forward. On one side, the demand situation is significantly improving. On the other side, the input cost, the energy cost is remaining on a lower side. And this is a perfect combination of formula for generating higher amount of profits in coming period. We remain distinctly convinced and bullish about, I think, the possibilities of metals giving the record performance in 2024 and beyond. So that is one space I think one would like to get into, whether it is PSU or private sector. But we believe that I think the companies could possibly end up giving relatively better performance in coming period.
Small caps moving this year. Devin bhai, across the board.
Yeah, I think it's one of the reason for I think some of these small caps moving is largely that the values in the hands of individuals have actually I think increased in their portfolio, and as a result of which their ability to buy some of these small cap companies in the portfolio is remaining extremely high. In fact, if you notice some of the IPOs and the pre-IPOs also, most of the times, I think the family offices and HNIs are the ones who want to bid for these companies in their portfolio. Largely because of the fact that their portfolio size itself has grown to such a size, I think more than I think some of the smaller mutual funds, that they are in a better position to buy into these companies, and as a result of which higher demand is generated. Because of this higher demand generated, I think and the lower floating stock comparatively, the ability to buy into the portfolio remains extremely high for these HNIs and the family offices. And that is resulting into significantly stretched valuations, if I may add to use that word, in some of the small cap companies and the mid cap companies, where probably discounting has been far beyond 525 and 526. But to a greater extent, I feel that I think it is due to some of the shortages in the market as far as the new papers are concerned, given the size of money that the people are holding. That's a reason for which I think these companies are commanding higher valuation. Maybe they are due for some correction in coming period. May not be sharp correction, but it would be definitely a time correction that one would expect out of this company.
Interesting. That's a view coming in on stocks within the broader universe. But there's also, latest reports out on the NBFC space, which seem to suggest that now there
is a bit of a marginal deterioration across metrics. Asset quality is going to be very keenly monitored, and you are going to see some growth pressures coming in for the likes of Muthoot Finance, LIC Housing Finance, PNB, Canfin, etc. So wanted to get in an expert view as well on the entire sector and whether or not now the view is turning a little bit cautious within the entire NBFC basket. Would you tend to agree, Deven?
Yes, Evan. I think most of the NBFC companies are having a good situation in form of collecting high deposits. And that's where the pressure is arising, that with the higher amount of deposit getting collected, they are also wanting to basically being deployed in a quick succession. And that's where mistakes are happening. I would rather like to stay with the larger NBFC companies like Bajaj Finance, like I think Poonawalla Fincorp, where the ability to lend, I think, is definitely there, but at the same time, ability to assess the credit profile of the borrower is extremely high by this company. So that gives you the confidence that these companies are unlikely to create non-performing assets in their books, and that too in hurry. So to a greater extent, I would think that I think one will have to stay with the quality player in NBFC space. May not be, you cannot be generalizing everything at one scale, and probably I think we'll have to remain watchful about the euphoric condition happening in some of these companies. So we believe that even if it is a gradual growth in companies like Bajaj Finance with around 30% kind of CAGR growth which continues, we believe that I think it is safer to buy and stay in these kind of companies than to buy into some of the smaller ones who are vulnerable to the situations.
Points higher is what GIFT Nifty is indicating, which frankly is not bad. Naresh, you'll appreciate the fact that how much we want you to smile, but you smiled only on day one. Let's continue the tradition.
There we go again.
There you go again. So nice of you, Naresh, to see you smiling. Okay, Naresh, what could make traders smile in the month of Jan? Will it be long, will it be short, or will it be no trade? I mean, there are three options for traders. Ride the momentum of November to December to Jan. Go against what the price trend is, which is start buying puts or start writing calls. Or third, just don't do nothing. I mean, just take a chill pill. What do you think traders should do in the month of Jan?
So the one thing which could make happy traders would be a new sectoral rotation wherein the market goes sideways and we see a sector doing well and you catch on to that. So for example, the last whole year, it was all about PSUs. So going forward, if there is a new sectoral change, that could make us happy. But overall, this is a time one has to be much more cautious, a lesser trade, as you said. So it is difficult to have a no trade period, but overall cautious in the sense of sizing, because we've had a good run. The Nifty has moved up, the Bank Nifty has moved up, mid cap, small cap, everything has moved up. So a correction or a shake-off could be normal. We've seen shake-offs 3 times over the last few months, and we've seen a 3% cut on small cap index on a single day. So that's the risk, and that's the reason one needs to be controlling sizing rather than trading. So, and the best way to ride is to continue to hold on positions and control the size. So time to reduce some leverage rather than trading.
Fair enough. Of course, not very low volumes will be helpful to the traders, but at least churning is something that will excite some of the traders, definitely. But Deven, what's your view on ZMAO specifically? There's an increase that has come in the platform fee, and while the number looks very small, it does have a very big impact on the profitability because it just kicks in at that operating leverage level.
Yes, I think they've tasted the blood. Last time, I think when they increased to 1 rupee, I think in the last year, I think it gave them a fantastic kind of a response also at the same time, because they did not see any kind of drop in the business, etc. I guess I think that is giving them confidence to keep on adding this particular fee. Yes, I do agree that I think this is one area through which they can bridge the gap between the valuation and the revenue and the profits. That is where probably I think this company could give a star performance. However, one will have a little bit more mindful at this point of time in a situation wherein I think their ability to increase very rapidly these fees, I think would probably will come under pressure, given the kind of local presence that most of the retail food chains would have in their local areas. So obviously, I think today they probably may have increased the fees and they've been giving the better value services to the customers. but that ability would remain always restricted to a greater extent. So one will have to wait and see. As such, at this point of time, the stock is fully priced. To my mind, I think given the kind of possibilities, market has already discounted the stock price well in advance. So one will have to wait and see how exactly the growth in the profit comes out to justify the valuations at this point of time in the market.
17 points higher for GIFT Nifty. Kunal, what to your mind, and the same question what I asked Naresh, in terms of in trading strategy should be, stay with the momentum, chalti gaadi hai baithe raho. Second, go on the other side when the odds of getting it, if you get it right, are going to be disproportionately higher, which is just go against the other side. And second is chalti gaadi se utar jao, which is don't trade.
I think it always makes sense to not be adventurous in a moving vehicle, to put it very simply. So I think I'll stay with the trend, stay with the course for the indices in terms of staying long for the index. And I think it makes sense to hold on to long positions over here. So in every kind of a bull trend or an upward trend, there would be always those few odd jerks which happen in between. But if those few odd jerks they don't lead into any kind of a major trend reversal, then the resultant effect of that is that the market gets a push up higher. So just for example, I think last 2 weeks back or 2.5 odd weeks back, there was this sharp single day drop of more than 300-400 points on the Nifty. But what happened post that was the Nifty moving up from 20,900 to now 21,700, 800 levels for the index. So that's the kind of trend which we are looking out for. And yesterday was just a 50-100 point drop on the Nifty. So I think that should not deter a short-term trader, especially the one who's been holding on to long positions much prior.
Point taken. Deven, I wanted your view regarding the IT pack as well. Now, just at this time next week, we'll be perhaps talking about some of the numbers which are expected from TCS and HCL Tech and the likes, and the expectation is fairly muted. But if you look at the month of December or the last 1 month or so, Nifty IT has actually gained almost 10%. What do you make of this, and what should people do right now with the portfolio that they have in IT?
Anisha, I think one will have to wait for the commentary to happen, I think, post results in this particular quarter. It is expected that 2024 is a year in which most of the companies, the global companies, the customers of some of the Indian IT companies, are expected to give a good direction as far as their new order release is concerned. There is no choice left with most of the companies on two counts. One, because of the cloud computing, they will have to soon migrate to, I think, the entire infrastructure to cloud, which even today, the Fortune 500 companies, out of which only 30% of the companies have migrated to. So for the cloud computing pressure, I think they will have to migrate onto this particular infrastructure. Second most important trend change which we are observing currently is the trend change happening in case of AI and AGI. I believe that I think this is where the compulsion is coming for most of the businesses, wherein sooner they will have to adapt to the newer platforms, largely because of the fact that I think the business is demanding extremely high amount of data intelligence, as I would call it as. And that's where probably I think you are likely to see larger amount of order books flowing in to Indian IT companies. And I'm referring to some of the large cap companies, the Infosys, TCS kind of companies, where they have some of the larger customers who are giving them orders for a longer period of time. That is where I think we would like to listen to the commentary of this management. As far as the mid-tier IT companies are concerned, we remain fairly convinced about their growth program and growth trajectory, largely because I think they operate in the niche space. And I think somewhere we find that I think in this niche areas, they hold the dominance as far as I think their customer books are concerned. So to a greater extent, we find that this is going to be continuing growth opportunity of around 25 to 30%, particularly in engineering and R&D space, where we remain largely comfortable. So any correction in the price, I think that would be an opportunity to buy. But otherwise, look at the commentary which comes out from this management.
Tata Power, JSW Steel, JSW Power, NTPC, NLC, just about everything in the power space was really on 440. Deven bhai, they say that anything above 440 is dangerous in terms of voltage. Power stocks are doing more than 440. Should we be reminded of that danger sign wo har power board ke bahar hota hai na, that sign, cross sign? Is that the story for power?
think on one side, the fundamentals are remaining absolutely convincing and intact. I think there is no questions on that aspect for most of the power companies, including, I think, the pricing challenge, which was up till now always having some amount of challenge in case of, I think, most of the power companies. Second side, I think the demand generation is now happening more from the renewable space. That is where I think these companies are relatively better placed than ever before that they were. So from that perspective, I think there is no challenge on that front. However, as you rightly observed, I think the valuation wise, most of the companies have reached, I think, to a peak level at which I think the comfort level is gradually reducing. I would say that despite of all the positives, if the valuations they go up in hurry, there may be a situation of some kind of a time correction, if not price correction, into these stocks. I think at some point of time, one will have to wait and see. I'm not bearish, but at the same time, I would like to remain a little bit more careful in adding the stock into the portfolio. Those who are holding it, I think they can continue to ride this particular wave because the challenge is that I think most of the funds are requiring to deploy their funds. Every month, I think on the first day of the month, they end up having the 17,000 crore worth of SIP entering into their books. They have a challenge to deploy this money. So obviously, I think they would put money behind the areas where the ability to scale up would be high, even though I think the valuations are at reasonably comfort or high level or fair level. So from that perspective, I think you will see that sort of challenge. I think liquidity is driving the push as far as some of the power companies are concerned.
Okay, so those are the views coming in on the power sector and how you should one approach that, whether there is a danger sign brewing there or not. But before that, let me, thank actually Deven for making time and speaking with us. Appreciate you joining us today. Time now to take the mid-cap bets as well from a technical expert. So Kunal, what's the mid-cap idea?
So there'll be a buy CESC, a stock which we've been flagging off over the last couple of weeks. Looks very attractive even at current levels of 135 plus, where the stock closed yesterday. The momentum is on its side. The stock has made a fresh swing high. So would look out for higher targets now, 144. Stop loss could be trailed to 130.
Okay, so CESC is one of the top bets. Naresh, what are you identifying?
So that would be a buy on Varroc Engineering with a stop loss at 530 and a target price of 650. The stock has given a multi-year breakout. The stock corrected from closer to 500 odd levels pre-COVID. Then in 2021 came very close to 450, 500. Again in 2022. And then in 2023 also took a pause around 500, took a little dip and then gave a breakout above 500. And now we are seeing a fresh range at 500 to 580. So a big breakout done of last 3-4 years, eventually expecting a breakout above 550 and a quick move to 650 and much higher in the medium term. And the whole auto ancillary pack, this has been one of the underperformers. Could be time for it to take charge.